Two people, same loan, same interest rate, same day they signed the papers. 2 years later, one of them is $40,000 richer than when they started. The other one's still grinding through payments, wondering where the money went. I want to tell you what separated them. But first, you need to know something about the person who was still grinding. Her name was Rosa. And what she figured out in month 19 is the only thing this video is about. Before I show you what Rosa learned, I need to give you one piece of math. It explains everything you're about to see, and it fits in one sentence. A loan is just rented money. You borrow a sum, you pay a fee while you hold it, and you give it back. That fee is the interest rate. That's the rent. So the only question that actually matters is this. When you take that rented money and put it to work, does it earn more than the rent costs? If the money you borrowed earns 7% and the rent on it is 4%, you kept the difference. 3% on money that was never yours. That gap has a name. It's called the spread, and the spread is only half of it. The other half is how many dollars you control for every dollar of your own you put in. That's leverage. Multiply the spread by the leverage, and you get the one number that tells you whether you're using debt or whether debt's using you. Your return on your own cash. That's it. That's the entire game. I'm going to show you 6 ways it plays out, from what Rosa did in month 1 with a couple $100 to what billionaires do with portfolios worth more than most countries. I'll tell you exactly which ones you can run today and which ones you can't yet. And I'm not going to dress up a billionaire's tax strategy as your Tuesday afternoon project. But you need to see all of it because the small moves only make sense once you've seen where they're pointing. Rosa didn't start with real estate. She didn't start with a stock portfolio. She started with a $200 supplier order and a 30-day window to pay for it. Here's what happened. She was selling a simple product, steady demand, predictable margins. The beginner move? Buy inventory upfront with your own cash. Sit on it for weeks. Hope it sells before rent's due. That's the slow version. Rosa's supplier gave her net 30 terms instead. She got the product on day 1 and didn't owe anything until day 30. By day 22, she'd sold everything. She used her customers' money to pay the supplier. She kept the difference. Now run the number. What was Rosa's own cash in that deal? 0. She controlled an entire inventory cycle with none of her own money. Her leverage wasn't 5 to 1 or 10 to 1. It was infinite because you can't divide by 0. The spread was small, just her margin per unit. But a small spread times infinite leverage, still enormous. That's trade credit. Oldest trick in the book. The seller never needed money. They needed terms. And here's the thing, you don't need a factory overseas to use this. A 0% intro card that floats your inventory. A supplier who gives you 30 days. A customer deposit that funds the job before you've spent a dime. Same mechanism, smaller scale. Rosa started there. By month 6, she'd figured out a bigger version of the same trick. The bigger version lives in real estate. And this is where most finance channels get the math completely wrong. So let's actually run it. You find a property for $500,000. Rough shape. Nobody wants it, which is exactly why it's cheap. You put 20% down, that's $100,000, and take a mortgage for the other $400,000. Then you spend $50,000 fixing it up. Your own money in the deal right now. $100,000 down, $50,000 in renovation. $150,000 of your cash sitting in this house. Now it's fixed up. People actually want to live in it. Market value rises to $700,000. You go back to the bank and refinance, pulling out a new loan at 80% of the new value. 80% of $700,000 is $560,000. You pay off the original $400,000 mortgage. You walk away with $160,000 in cash. Here's where most channels get it wrong. They'll say $160,000 minus your $50,000 renovation equals $110,000 profit. That's not what happened. And the truth is actually better. You put $150,000 of your own cash in. You pulled $160,000 back out. You got every dollar back, plus a little extra. And you still own a $700,000 property with $140,000 in equity that you can now rent out. Run the one number. Your own cash left in the deal? 0. Return on 0? Infinite. again. Rosa heard this, and her first reaction was, that sounds too good. Her second reaction, once she actually ran the numbers, was, that sounds hard. Both of those were correct. The catch is real. Your new loan is bigger. You went from owing 400,000 to owing 560,000. At current mortgage rates around 6%, that's a significantly larger monthly payment. Closing costs on the refi run another 2 to 5%. This only works if the rent covers that bigger payment, with room to spare. The trick isn't the refinance. The trick is finding a property that actually cash flows after all of it. That's the hard part. And that's the part nobody sells a course on. Now we go up a level. And this one explains every headline you've ever read about a billionaire paying almost nothing in income tax. Rosa thought it was a loophole, something illegal or at least shady, buried somewhere deep in the tax code. Then she read more carefully. It's three ordinary rules stacked on top of each other. Once you see it, you can't unsee it. Buy, borrow, die. Step 1. Buy. You own assets that go up: stocks, a business, real estate. On paper, you're worth a fortune. But here's the thing about paper gains: they're not taxed. You only owe tax when you sell. So rule 1 is simple: don't sell. Selling is what triggers the bill. But you still need money to live. So step 2, borrow. Instead of selling your stock and paying tax on it, you go to a bank and borrow against it. This is a real product. It's called a securities-backed line of credit. You pledge your portfolio as collateral, they hand you cash. Interest rate on these runs about 5.5 to 6.5% right now. Think about that against the one number. Your assets are growing around 7%. The loan costs around 6. The spread is still positive, and you never sold a thing, never paid a cent of capital gains tax. How much would that tax have been? Long-term capital gains rate goes as high as 23.8% once you include the investment income surtax. Borrowing at 6 to avoid handing over nearly 24, that's not just convenient, that's the entire point. You're renting money for 6 to dodge a tax of 24. Then step 3, and this is the cold one: die. Under current law, when you pass away, your heirs inherit your assets at what's called a stepped-up basis. The gains you spent a lifetime never paying tax on are simply erased, wiped clean at market value. Your kids inherit the stock. The loan gets paid off from the estate, and the lifetime of growth that was never taxed never gets taxed, ever. The government estimates this one rule costs about $41 billion in uncollected tax every single year. And before you assume the estate just gets taxed instead. In 2026, the estate tax exemption is $15 million per person, $30 million for a married couple. For almost everyone using this strategy, that final step is clean too. Buy, never sell, borrow, live tax-free, die, gains vanish. That's the machine. I'll be straight with you. This one is not for Rosa, not yet. You need a serious pile of appreciated assets before any bank writes you that line of credit. But I needed you to see it because the engine running underneath this strategy is exactly what Rosa's already building toward. And that engine has a dark side worth understanding before we go further. When you borrow against your investments, the lender doesn't give you a dollar for every dollar you have. They give you somewhere between 50 and 95% of your portfolio's value, depending on what you hold. And they watch it constantly. Because here's the risk: if the market drops and your collateral loses value, the lender can demand you put up more cash immediately, or they sell your assets out from under you to cover the loan. That's a margin call. That's the thing that turns leverage from a tool into a trap. Rosa asked the right question when she heard this. How do you know when leverage is working for you and when it's working against you? Here's the answer. And it's the thing every single move in this video has in common. The downside is capped. The upside is open. When you buy inventory on net 30 terms and it doesn't sell, your loss has a floor. When you do the real estate deal and the numbers go wrong, your loss has a floor. Every move in this video that actually works has a ceiling on the loss and no ceiling on the gain. That's not luck. That's design. The version without a floor is short selling. You borrow a share, sell it immediately, hope the price falls so you can buy it back cheaper. When it works, you profit from a company going down. But when you buy a stock, worst case it goes to zero, you lose what you put in. When you short, there's no ceiling on the loss. Price keeps climbing, your losses climb with no limit. Every other move in this video, floor on the loss, no ceiling on the gain. Short selling, no floor on the loss, no ceiling on the gain either. That's not leverage, that's a coin flip with someone else's heads. I'm showing it to you so you can recognize it and walk the other way. Now back to Rosa, because this is where the story actually gets good. Month 19. This is when Rosa figured it out. Not the billionaire strategy, not the real estate deal. Something she could do the same afternoon she learned it. She pulled her credit score, 682. Her coworker, Jake, same loan, same bank, same starting point from the beginning of this video. His score was 741. Same income, same amount of debt. But Jake was paying $180 less per month on the same mortgage amount because his interest rate was lower. Over a 30-year mortgage, that gap adds up to over $64,000. For a number Rosa had never once thought to check. Your credit score is the single biggest lever on what your money costs. The national average right now is 715. The difference between a fair score and an excellent one can be several percentage points on every loan you take for the rest of your life. On a mortgage, on a car, on a business line of credit, those points compound into tens or hundreds of thousands of dollars over time. The rich don't have access to some secret bank. They have access to cheaper money because they made themselves cheap to lend to. Rosa raised her score from 682 to 771 in 14 months. Three things: pay on time every time, keep credit utilization below 30%, don't close old accounts. That's it. No tricks, no hacks. Almost entirely in her control and almost entirely in yours. But Rosa didn't wait 14 months to start moving. She went after the 0% play first. Right now, balance transfer cards will give you 0% interest for 18 to 21 months. Some go to 24. There's a transfer fee, usually 3 to 5% upfront. That's the only cost. So run the one number. You're renting a chunk of money for roughly 3% total for nearly 2 years. If what you do with that money clears 3% over 2 years, which is a very low bar, you keep the spread. Let me make this concrete with numbers that look a lot like Rosa's situation, and probably yours too. Say you're carrying around $6,200 in credit card debt at 24% interest. You move it to a 0% card. You pay a transfer fee, 3%, call it $186. Over the next 12 months, instead of paying roughly $1,488 in interest, you pay nothing. That's a 700% return on the fee you paid. You didn't invest in anything. You didn't take a single risk. You just stopped being on the wrong side of the spread. The billionaire borrows at 6% to avoid 23.8% tax. You borrow at 0% to avoid 24% interest. Different scale, identical math. 18 months after Rosa learned the one number, credit card debt gone. Credit score up 89 points. Trade credit terms with 2 suppliers. And a savings account she's building toward her first real estate deal. She didn't become a billionaire. She just stopped losing. And then she started winning. Same loans, same math, different question. Here's what you do with this, starting today. First, the cost side, because it's the fastest win and it costs you nothing. Pull your credit score this week. Find out what your money actually costs right now. Every point you raise lowers the rent on every dollar you'll ever borrow. That's pure upside. Second, flip the spread. If you're carrying a balance at high interest right now, you're on the wrong side of the one number. You're the factory lending to the credit card company at 24%. Move that balance to a 0% offer. Pay the 3% fee instead of the 24% rate. You just turned a negative spread into a positive one. You could do that today. Third, the float. Get paid before you have to pay. Take the deposit before you buy the materials. Use the 30 days your supplier gives you. Every time you do it, your own cash in the deal drops. And the one number climbs because you're dividing by less and less of your own money. Here's the whole video in one line. Debt is rented money. The only question that ever mattered is whether what you do with it earns more than the rent. Get that one inequality on the right side, and debt stops being the thing that owns you and becomes the thing you own. The poor pay debt off as fast as they can. The rich ask what the spread is and how many dollars they can control. Rosa asked the right question. Now you have it too. If this changed the way you see the loans in your own life, that's the whole point of this channel. We run the numbers so you don't have to take anyone's word for it. Subscribe, and next video I'll show you exactly how Rosa is building toward that first real estate deal. The numbers, the timeline, and where most people get stuck. I'll see you there.